Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing MPLX by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. MPLX transports and stores energy. Their assets include a network of crude oil and refined product pipelines, an inland marine business, asphalt, heavy oil, and marine terminals, crude oil and natural gas pipelines, as well as natural gas and NGL processing and fractionation facilities. Fractionation separates the molecules in order to create products such as propane, butane, and ethane. Marathon Petroleum owns the general partner and majority limited partner interest in this company. Marathon is a downstream company with a market cap of $49 billion. MPLX is an MLP, a master limited partnership, pays a lot less taxes than a traditional corporation. It avoids double taxation. To qualify, the business must receive 90% of its revenue from natural resources or real estate. Pretty much all dividends received from an MLP are taxed as ordinary dividends, which is the higher tax rate, so you pay the higher tax rate. Qualified dividends is the lower tax rate. If you receive dividends from Microsoft, you're probably paying qualified dividend tax rate. If you hold an MLP stock in your retirement account and receive more than $1,000 of dividends, it is considered unrelated business taxable income, which makes it subject to be taxed immediately. For this reason, some people suggest not to have MLP stocks in a retirement account. The company is headquartered in Findlay, Ohio, and was founded in 2012. The ticker trades on the New York Stock Exchange. Let's get started with the model. This is a large cap company, 34 billion market cap. They're trading at $34 a share, and they have 1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow grows a ton each year, from 900 million to 1.7 billion to 3.3 billion to 4.4 billion. Pretty impressive growth. Net income is the profit or loss on the income statement. It's revenue minus expenses. That was negative in 2020, probably due to lots of write-offs, and it was over 3 billion in 2021. Revenue is a sales for the company, and that grows a lot, from 6 billion to 9.5 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you your gross profit, and that was the highest in 2021 at 4.1 billion. Below that is their operating expenses. These are all the expenses not directly related to generating the revenue. Gross profit minus operating expenses gives you your operating income, and that peaked in 2021 at 3.7 billion. They paid about 800 million of interest on their debt, which is lower than 2019 and 2020, and they had $86 million of financing costs. And you could see the reason they had negative net income in 2020 was this large negative in other income and expenses. This is most likely an asset impairment. Then you have your pre-tax income. They don't pay much in taxes since they're an MLP. And then the bottom line of the income statement is your net income, which was highest in 2021 at over 3 billion. This is the company's income statement from their annual report, and they give us a lot of detail on their income. Service revenue is over 6 billion. Rental income was about 1 billion. Product sales, selling the commodity, that was about 1.7 billion. Sales type lease revenue, 435 million. We talked a lot about this on the live stream yesterday. And they received 300 million from their investments in other companies. I'll show you their investments later on when we look at their balance sheet. So their revenue is up a lot in 2021, 10 billion, compared to 7.6 billion last year. The reason my revenue is a little different on my Excel file is because I don't include the equity method investments. I consider that other income and expenses. But they did note revenue and other income. And here's a breakdown of all their expenses. 1.2 billion in cost of revenue, 1.6 billion to purchase the oil and different products, 1.3 billion in depreciation. Their operating income was 4 billion. Last year was only 200 million. The reason their numbers look so good in 2021 is because the price of oil came up a lot in 2021 compared to 2020. The price of oil got really low in 2020. So for a few months there, lots of oil and gas companies were losing money. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated nearly $5 billion of cash flow in 2021. It is a little higher than 2020, $1 billion higher than 2019, a lot higher than 2018. And they spent a lot on CapEx each year. It was only $500 million in 2021, but $1.2 billion in 2020 and $2.4 billion in 2019. These are investments in property, plant, and equipment. Operating cash flow minus CapEx gives you your free cash flow. And they paid a really nice dividend in 2021 because they had extra free cash flow. They also bought back lots of stock, $630 million of stock. That's another way to reward investors, to buy back stock. Those are by far the two main ways to reward investors, pay a dividend or buy back stock. In 2020 and 2021, they issued a similar amount of debt as they paid off. But in 2018 and 2019, they issued a lot more debt than they paid down, especially in 2018. Since MLPs must pay at least 90% of their cash flow back to their investors, they tend to take on a lot of debt to fund growth. This is the operating section of their statement of cash flows. And the way to calculate operating cash flow, you start with your net income, $3.1 billion. You add back the non-cash items on the income statement, $1.3 billion of depreciation. We pass through that equity method gain. We have to minus that out. It's a non-cash item. Then we have to adjust for changes in working capital. So even though they reported an accounting profit of $3.1 billion, they actually generated nearly $5 billion of cash flow. Last year they reported a loss, mainly due to this large impairment of $2.2 billion. But impairments are non-cash items, so we add it back here. That's why operating cash flow gives you a much better picture of how the company's doing than net income. Especially companies with a lot of write-downs, operating cash flow is a better indicator of how the company's doing than net income. I like to track a company's revenue, that's the blue line, and operating cash flow, that's the orange line. And it really doesn't get much better than this. Look how much they've been increasing since 2015. The company did start in 2012, so it's probably small and building out its infrastructure. And for all those people who invested in the company when they started, if they're still holding, they're receiving a really nice payoff. This is the investing and financing sections on their statement of cash flows. In their investing section, they spent $500 million in CapEx. This is 2021, this is 2020, this is 2019. They received $126 million from selling some assets. They invested $151 million in their affiliates, so they had a cash outflow of $500 million in 2021. In their financing section, they took on $4.2 billion of debt. They paid $5.8 billion of debt. They added another $8.5 billion of debt, and they paid down $7 billion of debt. They bought back $630 million of stock. They bought back $100 million of Series A preferred units and $41 million of Series B preferred units. They paid out $3.4 billion of dividends. So in their financing section, they had a cash outflow of $4.4 billion. This is the equity section on their 12/31 balance sheet. They have $11.8 billion of equity. They call it partners capital since it's an MLP. They raised $11 billion from selling common units, and they raised $600 million from selling preferred units. And MLPs don't report retained earnings. Let's look at the capital structure. $13 billion of equity, $19 billion of debt. They're 40% equity, 60% debt. This red line is their debt balance each year. And you can see it's currently higher than their equity balance. At some points, their equity was higher than their debt, but they've been going back and forth. It's pretty common for MLPs or REITs to take on a lot of debt because they have to pay back most of their profits back to investors in the form of a dividend. They keep very little cash on their balance sheet at any given time. That's the green line down here. I gave them the highest whack on Finbox, 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year for that $61 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $37 billion. We divide that by 1 billion shares. And we get a calculated stock price of $36. They're trading at $34, so they're trading at a 7% discount. It's a buy according to the model. I did a video on this company back in February of last year. They were trading at $25. My valuation was $31. Their revenue target for 2024 is $10.3 billion. That's how I got $10.3 billion down here. For 2023, it's $10.2 billion, and for 2022, it's $10.1 billion. And then I just continued the trend into 2025 and got $10.3 billion. They converted 43% of their revenue into free cash flow in 2020 and 2021. So I multiplied their future revenue estimates by 43%. That's how I got their future free cash flows. Because the company was growing a lot up through 2020, so it seems to have stabilized now. That's why I used a percentage from 2020 and 2021 and not prior years. The website Simply Wall Street values the company at $50. They're saying it's 32% undervalued. 10 analysts priced this stock and the average price target is 37, the lowest 33, the highest 40. This is where the stock has been trading the last 5 years. So it's trading pretty much where it was 5 years ago, but it took a major crash in March and April 2020 due to COVID and also when oil prices became negative. It has come up a ton since the bottom. But even if you bought the stock 5 years ago, you're not flat. You're still receiving a really nice dividend payment. This bottom chart is the price of WTI crude. So if you want to know where the stock price moves, just look at the price of oil. Because as you can see, their stock pretty much tracks the price of oil. So if you're able to predict the future price of oil, let me know. I still haven't been able to figure that one out. Here's MPLX's stock price compared to Enbridge, ET, and ONEOK. And this is in the past 5 years. ET is down 38%, MPLX is down 3%, Enbridge is up 7%, and ONEOK is crushing it, up 29%. This is their dividend payment since 2017. So you can see they were consistently raising their dividend, but they had a huge cash inflow at the end of 2021, so they paid a really high dividend, $1.28. So they paid their regular dividend and then added about 60 cents for a special dividend. Special dividends are not common. Most companies never pay one, and it's very rare for a company to pay more than one special dividend. So their dividend yield is a whopping 8.3%. The way to calculate that, you can multiply the 71 cents by 4, that's $2.84, and take that number and divide by the stock price. That's 65% of their free cash flow, 92% of their net income. This is their dividend yield since 2013. And at one point, their dividend was at 17%. That's just crazy. But the projection is for their dividend to grow a little bit the next few years and be around 9.2% in 2024. They have a beta of 1.7, so the stock is more volatile than the market. It's gone up 27% in the past 52 weeks, while the S&P is up 2%. The 52-week low is 26, the high is 35, and the stock is trading above its 50-day and 200-day moving average. 2 million shares are traded each day on this stock. Of the 1 billion shares outstanding, 365 million are on float. 25% are held by institutions, and 5% of the shares on float are shorted. The CEO's salary is $1.6 million in 2021, and their total compensation package is $21 million. If you put $10,000 into this company 10 years ago and reinvested the dividends, you would have been at $30,000 after 2 years. After about 8 years, you would have been down on your investment, but if you kept holding, you'd be at $24,000 today. That's almost a 10% annual return. Public companies own 64% of the stock, 26% by institutions, 10% by the general public, and 0.2% by insiders. Marathon Petroleum is the biggest shareholder at 64%, then Blackstone, Harvest Fund, Invesco, and Alps. Let's look at their financial ratios. An amazing PE of 11, stock price over earnings per share. That means investors are paying $11 for $1 of earnings, which is much better than the market median and market average. Price to sales of 3.6, price to book of 2.7, and a really good price to free cash flow of 7.8. Let's look at their non-current assets, $4 billion of equity investments. Here's a breakdown of the $4 billion. They break it up into 2 categories, logistics and storage, and gathering and processing. And here are the companies they own. So they own a lot of companies. Some of these companies may be private and some are public, but I'm not too familiar with many of these names. They don't really jump out at me. They have $20 billion of PP&E. Here's a breakdown of that $20 billion. Once again, they break it up into logistics and storage and gathering and processing. Their pipelines are worth $6.3 billion. Their terminal is where they store the commodity. Land and buildings, $8 billion of gathering and transportation, $6 billion of processing and fractionation. I explained earlier what fractionation was in the opening of the video. The gross value is $26.5 billion. The accumulated depreciation is $6.5 billion. The book value is $20 billion. That's the value that's reported on the balance sheet. They have $830 million of intangibles, $7.7 billion of goodwill. Goodwill is the premium you pay when you acquire another company. $268 million of right-of-use assets. We talked a lot about this on the live stream the other day. These are assets they lease from another company. $1.2 billion of non-current assets and $60 million of other. Here's a breakdown of their non-current assets. MPC stands for Marathon Petroleum. $31 million of long-term receivables, $229 million of right-of-use assets, $859 million of long-term receivables. These are all assets they lease from Marathon Petroleum. Let's look at their non-current liabilities. $383 million of deferred revenue. Deferred revenue is when they receive payment for product or service they're going to deliver in the future. $300 million of long-term liabilities. Here's a list of the long-term liabilities they're leasing or borrowing from Marathon Petroleum. The present value of the future lease payments is $228 million. Then there's deferred revenue of $74 million. They have $18 billion of long-term debt. Here's a breakdown of their long-term debt. Most of the debt is due after 2024. There's some even due in 2058, 2049, and there's some due in 2022. There's $499 million due within 1 year. So we'll see $499 million on their current liability section later. They have $10 million of deferred income taxes. This should increase their taxes in the future. They owe $200 million on long-term lease liabilities. And they have $170 million of deferred credits. Oil and gas companies tend to receive tax credits from the government. Their return on invested capital is 9%. They can cover their interest payments with their operating income almost 5 times. They have a really high ROE of 24%. They can only cover 50% of their current liabilities with their current assets. Their quick ratio is even worse at 0.4. Let's look at their current assets. $13 million of cash, $654 million of receivables. This is how much money their customers owe them. $644 million of current assets, related parties. Most of this is related to Marathon Petroleum. This is how much money they owe MPLX. They have $142 million of inventory. Here's a breakdown of the $142 million. $12 million of natural gas liquids, $23 million of line fill, and $107 million of spare parts, materials, and supplies. And the last thing in current assets is other of $54 million. Let's look at their current liabilities. They owe their vendors $172 million, $363 million of accrued liabilities. These are expenses the company has incurred but it has not paid it yet. $1.8 billion of current liabilities, related parties. This $1.8 billion is owed to Marathon Petroleum. They have $97 million of accrued PP&E. Here's that $499 million of long-term debt due within a year. They owe $200 million of interest on their debt. They owe $59 million on their operating leases. And other current liabilities is $176 million. They generated $4.4 billion of free cash flow in 2021. They have negative $1.8 billion of working capital. And they have $2.8 billion of dividend payments. So it looks like they're going to be short $300 million. They may need to add a little debt in 2022 unless they generate more free cash flow. The best way to look at ratios is to compare them to companies in the same industry. There are 56 companies in the same industry as MPLX, and MPLX ranks 8th in market cap at $34 billion. The average is $11 billion. And if they have a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're pretty much better in every single category except price to sales. They're a little worse than average. They're doing much better in price to book, price to earnings, and price to free cash flow. Their revenue is growing at a great rate, 13% average the past 3 years, much better than average. And they have a really high ROA and ROE. And of course, the dividend payment, the reason a lot of people invest in this stock. It's pretty much double the average. So to summarize, I have them trading at a 7% discount. But as I showed you earlier, the stock tracks the price of oil. So if oil goes up a lot this year, so will this stock. And with the conflict in the Ukraine, it seems like there's a good chance oil will continue rising. I ranked their free cash flows, revenue, and ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.